Okay, problem 8.5a is a classic depreciation problem. The first thing it asks us to do, it tells us that they paid for a truck, they paid $20,515 plus $1,485 in sales tax. Well, that gets added. The $20,515 and the $1,485 gives us $22,000, and that's the recorded cost of the truck. That's the capitalized cost. So we're going to record that. We're going to debit the truck, $22,000, and credit the cash, $22,000. That's an asset shift. We took one asset, cash, turned it into a different asset, truck. Then at the end of the year, we have to compute the depreciation. And they use straight line. They tell us they use straight line depreciation, and it has a life of 5 years. So we're going to take $22,000 minus what's the salvage value, $2,000, divided by its life in years, $4,000. Because you remember, it's historical cost minus residual value divided by life in years. So to record the depreciation for this year, we're going to take $22,000 minus 2 divided by 5, $4,000. So our depreciation expense for the end of the year, December 31st, is we're going to debit depreciation expense, $4,000, credit accumulated depreciation, $4,000. Pretty straightforward. Now the next year is when they start making things a little interesting for us. In 2017, a couple of things happened. And I need to make sure you get all of these. The new information, they realized the truck's useful life was reduced from 5 years down to 4 years. So we really only have 3 years life left on this truck. That's the first thing you have to see. The other thing you have to see is that because we're going to use the truck less, they believe the salvage value is going to go up to $2,400. So that's a $400 increase in the salvage value. So let's figure out what our depreciation is going to be. When we bought the truck, we paid $22,000. Okay, so we have to handle that first. So we bought the truck, $22,000. Last year, we took $4,000 depreciation expense. So we need to subtract that. That gives us a book value of $18,000. Our new revised salvage value is $2,400. So we have to subtract that, and that gives us $15,600 as the remaining value to be depreciated. But remember, we reduced the life from 5 years to 4 years, and we used up 1 year, so we only have 3 years left. So we take the 15.6, divide by 3, 5,200 is our new annual depreciation. So we take our 3, revised useful life. Well, they want us to do it step by step. Revised useful life was 5. We've now changed it to 4. We've used 1, so now there's 3. So 15,600 divided by 3, 5,200. Okay, what we paid minus the depreciation from last year, the new book value, minus the new salvage value gives us the new remaining cost to be depreciated, also called the depreciable base. The life had been 5 years. It was revised to 4 years. We used up 1 last year, so there's 3 left. So we take the 15,600 divide by 3, and that's our depreciation for 2017. So depreciation expense, 5,200. Accumulated depreciation, 5,200. Okay. Now they ask us to record the depreciation in 2018, and at the end of 2018 we're going to sell the truck. So first let's do the depreciation expense. That's easy. It's still 5,200 and 5,200. So depreciation expense 5,200 and accumulated depreciation 5,200. Now we sold the truck for how much? I forget. Let me see. They tell us we sold the truck for $5,300 in cash. So that's the easy part. Let's put that down. $5,300 in cash is what we sold the truck for. And the trucks go off the books at the total cost. So that's $22,000. But now we have to figure out what the loss on the truck was. And for this, it comes in handy to have a T account. So let's take a look at this. We bought the truck for $22,000. And accumulated depreciation and the difference between historical cost and accumulated depreciation is book value. The difference between book value and selling price is gain or loss. So the first year we took $4,000 in depreciation. The second year we took $5,200. The third year we took $5,200. So altogether our accumulated depreciation is $14,400. When you subtract the accumulated depreciation from the historical cost, $22,000 historical cost minus $14,400 accumulated depreciation, that gives us a remaining book value of $7,600. We sold that for $5,300 selling price. The difference between those, $2,300, is a loss on disposition of asset. Historical cost minus accumulated depreciation is book value minus selling price gives a loss. Now, if the selling price was greater than the book value, that would be a gain. So the loss on the disposal of the trucks was $2,300. And remember, the truck, the accumulated depreciation is attached to the asset. So we have this going off. So we have to debit accumulated depreciation, $14,400, and that will record the selling of the asset. So remember, we have to update the depreciation. Now, if we sold this in July, the beginning of July, the middle of the year, we would take half a year. We would do the same thing, but instead of having $5,200 in depreciation, we would now have $2,600. But it's done the same exact way. So, we've covered purchasing the truck, which includes the sales tax. We handled the first year's depreciation. We took the historical cost minus the residual value, divided by the then estimated life in years, which was 5. Then we had the revision, and we handled that somewhere. Where we took the $22,000, the purchase price, minus the depreciation taken to date, giving us the book value, minus the new revised salvage value, taking that and dividing it by the year's life in a revised estimate to give us the depreciation. It's a pretty good problem, covers all the bases on depreciation.